Crosscheck Media and Biz Talk Today TV. Welcome everyone to the Torres Report. I am your host, Todd Schoenberger, and joining me as he does every week is José Torres. He is the senior economist at Interactive Brokers. Jose, so much to talk about since the last show we did because we had the Fed meeting this week, the two-day Fed meeting, and the press conference after the non-event on the monetary policy move really should have just been a boring press conference, but it wasn't. So we had Chairman Powell say that he will stay in place if there is nobody to take his spot, i.e. Kevin Warsh being confirmed. Do you think markets right now are underestimating how dire that type of situation may be?
Well, Todd, great to be here. It's definitely not a happy Friday here in markets. Yields are soaring, stocks are falling. And I think while what you said is critical about him staying on until Warsh is or someone else is confirmed, I think what's even more significant, Todd, is that Chair Powell said that he would essentially stay on as governor. Because remember, his term as chair ends in May, but he can stay on as governor for a few more years. And essentially have influence as a voting member in the committee until the DOJ investigation against him is closed. So I think that was really the high impact high impact event that really sent interest rates soaring. And then alongside that hawkish Fed meeting, that hawkish pause, now we're essentially expecting a rate hike with a 50% degree of confidence in October, Todd. And that's really because it wasn't just Powell's comments. It's also that this war in the Middle East keeps worsening. There's more attacks on critical energy infrastructure. And for that reason, we're expecting here at Interactive Brokers, the CPI is going to come in above 3% for the month of March. We were just at 2.4 in January and February, which are great numbers considering where we've been. So to have a CPI coming in north of 3% and the PPI, Todd, is going to come in north of 4%. So, if the war extends further, those numbers get materially worse. So for that reason, it's not just the Fed. Australia hiked this week. The ECB is talking about turning around. There's 2 rate hikes priced in there, and then also the Bank of England. So really global central banks are gearing up for the end of the cutting cycle and starting to hike. Of course, by next week, if oil prices fall like a rock, we will be having a totally different conversation.
Well, we've been having many different conversations because since the Torres Report started, you actually were quite dovish. You were saying we were going to see 3 rate hikes this year alone. Then it was knocked down to 2. I asked you last week about rate cuts. I'm sorry, you said 3 rate cuts. Then last week we talked about rate hikes, and you said, look, there's nothing out there. Even for the predictions market at Interactive Brokers, there wasn't anything out there talking about rate hikes. Now, all of a sudden, the narrative has completely shifted. Forget about rate cuts. You're right. We are talking about rate hikes. So I have to ask that question. You have a rate hike. What does that do to the stock market?
Yeah, that essentially puts the stock market in a 10% correction. We're not far from there now. The S&P was at a high of just north of 7,000. So a 10% correction from there would get us to around 6,300. We're at 6,516 right now. It could get a lot worse, but that's really what I'm expecting. I think 6,300, that's, a decent opportunity to buy because, at that point, the oversold oscillators. So we look at CNN fear and greed, extreme fear, look at the VIX, you look at all the technical signals that essentially tell you if a market is overbought or oversold. Those things are really all flashing that these are good opportunities to buy. But of course, if the economic fundamentals are worsening a lot faster than technical signals, then of course that is going to have a more impactful, it's going to be a more impactful dynamic. So right now, that's really where we are. The fundamentals in the economy are just worsening a lot faster. And, dip buyers just don't feel comfortable coming in and buying, particularly, Todd, right before the weekend. We know during the weekend, markets are closed and sometimes you have intensifying attacks. But there's also a lot of pressure on the Trump administration here, Todd. The midterm odds are really bad now here at Interactive Brokers, our prediction market reflecting only a 54% chance of the GOP keeping the Senate. Starting the year, we were at around 73, 74%. Democrats, they've handily had a lead in the House of 75% to start the year. They're on 81%, 82% now. Oil prices are terrible. It's the sticker shock. It's one of the most impactful costs for consumers. It's that really in the stock market. It's something that it's so obvious. Folks, if they're used to paying $50 to fill up, now they're paying 80 or 90. They blame it on politics and similar to the stock market. And now there is somewhat of a concern that there could be a slowdown because, of course, the wealthier households, folks that had exposure to equities, folks that had exposure to real estate, they were really pushing the economy forward by spending so much on discretionary services. But now with the stock market down, down here in the Palm Beach and Miami metro area, whenever we have a bad down day in stocks, this is more like grapevine conversations that go on, but no one goes out to dinner. Tons of people. You go to either New York Prime here in Boca Raton, Buchan in Palm Beach. For those that are familiar with the area, if you're not, great places to visit. Meat Market as well. These places on Friday night, they're not as full on days where the market is down. So you have a risk that if markets don't improve quickly, that wealthy people are going to start pulling back. And then all of a sudden you have a real serious risk of a consumer retrenchment. Now, second half of this year could be a totally different story. President Trump is trying to ease the situation, but he still wants to maintain a tough stance against Iran. So if you have a quelling in that tension, if you have an end to the war, peace in the Middle East, then you have time for the 2025 legislation to really start to kick in those tailwinds in the second half of this year and get a cyclical reacceleration. And then you have a path for stocks to go to all-time highs back north of 7,000 in the S&P. But that'll only be modest gains for this year. This will be like a 5%, 6% kind of gain year. So not a 20% year like what we're used to. That's really, the best case scenario right now, Todd.
Are you surprised that nobody's really talking about this Kevin Warsh handoff? Because the Powell is supposed to be finished on May 15th. You're down less than 2 months now, and it might seem like a bit of a ways away, but Senator Tillis has already said, forget about it. We're not going to do anything with a confirmation for Kevin Warsh. What happens if Warsh or anyone else is not confirmed by May 15th and Powell stays in there? How do you see markets reacting? And obviously the economy, bonds, we talked about yields, but what about the stock market? That level of uncertainty now has got to just be a monster issue. But what do you think?
Well, I think this one is actually an easy one, believe it or not. If Powell stays on, Todd, it's a hawkish central bank. He's going to be more fast to want to hike than Warsh. Warsh is going to be newly appointed, presumably, so he's going to be under a little more pressure from the White House. He wants to appease, the president on his first days. Chair Powell has no real intention to want to please the president. So if he feels like he wants to hike, and already, let me look at the odds, but there are odds, Todd, here of a rate hike as soon as the next meeting. Let's just open up here.
As soon as the next meeting.
Yes, as soon as low 11% for April. June is 15%. July is 16%. September is 25%. In October, it was up to 50%. Now it's down to 35%.
That's incredible. So now the public is now expecting rate hikes happening. And so therefore, now let's just say, as an economist, when Chairman Powell talks about how the oil spike is a one-off event, I hate it that he says this. But because, like you said, he is hawkish. So is that of the belief that he thinks, oh, it's just a one-off event, but privately he's thinking this thing's going longer? Or as an economist, because there's no way, even if the war ends tomorrow, that the supply chain is going to open up that quickly in the Strait. So it takes time. I mean, this second quarter is looking like a disaster. But what do you think, though? I mean, are economists realistic when they're forecasting the future?
I think so, Todd. I think really what it comes down to is, do you think that this oil price shock is going to be more prolonged? Because if you just have a jump up, and we've spoken about this in previous shows, if you have a jump up for 15 days, 30 days, or 90 days, that's a huge difference. Because now 3 months, you have high oil prices, the month over month and the year over year comps now are, significant going back. So for example, right now we're at $98 on WTI. We were at around in the 60s on an average last year. So we're up 50% year over year. So if we stay at 98%, let's just say, presumably, all else equal, and we're comparing it to 65, we're going to consistently get CPI annualized readings, Todd, reflecting that 50% jump in crude oil prices. And that's going to be devastating. And that's why we're going north of 3% so fast. Todd, from 2.4% in 1 month to 3.1 in the next, that could easily become 3.8, 4.2, 4.5. But if it's a one-time shock, here's the number. Here's how the math works. If it's a one-time shock, that 3.1 is maybe 3.2, 3.3, back down to 2.6, back down to 2.5, and now things are fine. So that's really the math behind one-time shock versus a more pronounced, more extended elevation in oil prices.
That's interesting. So, and because of that, and we talked about PPI with the year over year at the highest it's been in a year right now. As an economist, is it true that the higher, when we see inflation on the PPI level, it does take a month or two before it does flow down to the consumer level? Or did I misunderstand that in economics class?
No. That's absolutely the case. And you can look at it. When you plot a line of PPI over CPI, you see that PPI jumps before CPI. And the reason is that input costs increase and that businesses have to feel that, but they get worried most times about passing the full cost on to consumers right away. So there's a lag on the supply chain from the original inputs to the intermediaries over to the final shelf, to the final end user. There's a process of passing that higher cost on to the consumer. Of course, there's worries that the end buyer will balk at those higher prices. So for that reason, there's a lot of concern about passing those prices on. And we're seeing that in corporate America. Margins are actually down on Wall Street. So despite earnings being potent, still growing, margins overall have been lower. That's partially the fuel costs haven't made it there yet. But partially it is some of the tariff impacts, driving those margins a little lower. Companies are eating that. They don't want, particularly the middle income and the lower income consumers, halting their shopping because of those higher prices.
Have there been any micro analysis as far as any pockets of the economy that you have seen slowing down over the, say, last 30 or 60 days?
Oh my goodness, real estate is doing terrible.
Wow.
39-month low in new home sales, 39-month high in inventory. Just a multitude of factors that are just really worsening the picture in real estate. Rates are too high. Even when rates come down, the 30-year fixed at 6% is too high. Americans aren't used to that. Sellers want full value. Sellers are not looking to work with what's comfortable from a monthly payment perspective. They want full value. It's an inflationary environment and things are expensive. So you still have this gap between buyer and seller expectations. You don't have the immigrants, the borders closed. That's also weighing on, that rental demand that works its way eventually to the home purchase market and to the landlord market. So you have weakness there. Manufacturing, though, has remained strong. So that's still a lot of AI stuff happening. That we heard from Micron, big spending, NVIDIA talking about the $1 trillion forecast in revenue. So there's still, the AI is still driving productivity. Manufacturing is doing well. Labor markets are doing fine. Layoffs are still subdued. The ADP report saw a little bit of a deceleration, but we're still healthy. Corporates don't want to reduce headcounts for the most part. Some are blaming essentially that would have done layoffs anyway, are blaming AI for the layoffs. So that's a lot of what we're seeing now. Businesses that are doing well, they're saying, we want to cut costs, but we don't want to hurt anyone's feelings. So let's just say that it's because of AI. So we're also seeing that. The consumer, those numbers, we have the government shutdown, so we still don't have a lot of the retail sales and the consumer spending numbers and the personal incomes and outlays report that comes out with the PCE. Those numbers have been a little funky. So those numbers will, as the government shutdown schedules reconciled and the collection processes are improving, we'll have a better read on what's going on there. But really, yeah, I mean, really, it's the market that's forward looking, and that's essentially pricing in the potential 30%, 40% chance by our prediction market here at Interactive Brokers that we'll have a recession this year. I don't think that's the case. I think the Trump put is alive. I think Washington is going to come in and save the day. But folks are certainly worried here.
So they're worried, they're filled with anxiety. I mean, if you're even talking and predicting a recession, I mean, the fact that anybody is doing that is cause for great concern. The final question I have for you, though, let's say Iranian war continues on as I think it looks like it's going to be, and we do see what the Saudis are saying is a 180 price per barrel in 1 month from now. What breaks first then, Jose? Is it the markets or the consumers?
It's going to be the markets. It'll be the markets first. Yields will rocket higher, and because the consumers could be breaking, but we really won't know until the data comes out, which that's going to be lagged. But of course, the stock market, you have prices every single day, so you can tell. So it'll be the market first. That'll be, I mean, unfortunately, Todd, if that happens, we're going to have a meaningful slowdown this year if oil prices don't plunge soon. That's the real situation here. I think Washington is going to save the day, though. They did it last year with Liberation Day. If those numbers on the board that President Trump brought out in the Rose Garden, the White House, if those numbers on the board were actually implemented, we would have had a global recession. But of course, President Trump, he pushes to the end and then he pulls back. But this time, it's more pronounced, it's more extended, and folks are waiting for the taco trade. We'll see, but right now there's no light at the end of the tunnel right now.
And last final question: has the war impacted your GDP forecast for the year?
Yeah, absolutely. We're down to 2% now. We were up north of 3% to start the year. Things were great to start the year. You had the Russell 2000 buoyant, the Dow doing terrific. No one really, was too worried about the fact that AI the enthusiasm was fading and the NASDAQ was rolling over a little bit. We had a lot of the old school economy names starting to do better. But now, it's everything is doing poorly because higher yields, of course, are bad for valuations and are bad for the cycle. So it hurts tech and the old school economy names.
Wow, that's amazing. Jose, we're going to leave it there. That's great. You're clearly the smartest guy in the room. You live in South Florida, and I'm sure the weather is just spectacular there. So that's a very smart move on your part.
Not bad. Wall Street South.
Absolutely. Well, we'll definitely continue the conversation next week when the Torres Report returns next week. So definitely want to check your local listings. But on behalf of Jose Torres, I am Todd Schoenberger. Thank you once again for joining us on the Torres Report. We'll catch you next time. Take care.